smile through. Good morning to you.
Okay, welcome everybody. Happy Friday. Let me just check on my tech here. Welcome to first virtual coffee for 2025. Hope everyone is having a fruitful year so far. Amazing how fast time flies, almost about to hit March. So agenda today, the usual start with review of the performance, brief economic update, what returns have been doing. Also, we'll look at longer term returns, again, just for, I think, reminders of how good and how bad things can get. We're going to have a bit of a mini masterclass on what active versus indexing or passive investing is. And then we'll have a look at a couple of my favorite current money hacks. So thanks for joining me. Hope you've got your coffee. This is my local free plug for the Wooden Whisk. If you're ever in Crow's Nest, great coffee. I did also scoff a chocolate cupcake, so I have to go for a run later. All right, so let's have a look at the economic reports. Just a couple of things, really. I think always good to look at the housing market because it is such a big part of a big part of our psyche, and for most clients and most viewers, a big part of their wealth as well. Not wealth you can spend, but unless you downsize. So the polling for this year, again, this is just index, right? So not specific, not a specific city, but the index of house prices is for more moderate growth this year. As you can see, a forecast increase of 4%. Take this with a grain of salt. As we know, forecasts are often way off the mark. But I think this information here is very interesting. No surprise, because we look at these numbers on most of our virtual coffee chats, and that is 40% surge in Australian home prices in the past 5 years. Is it any wonder that younger buyers and less financially sound or well-off buyers are struggling to get into the market? In terms of interest rates, most of you would have seen that the Reserve Bank recently lowered interest rates for the first time since late 2020. So the cash rate is now 4.4%. That would flow through, obviously, the lower rates to things like term deposits and cash. Still a reasonable number in absolute terms. The main reason they did is inflation's coming down. So that's the silver lining to lower rates. You should hopefully, at least in theory, see less price increases. Doesn't mean prices aren't going up. It just means they're going up at a slower rate. The Reserve Bank is really saying they're going to look at, make their decision on future cuts depending on what inflation's doing. Pretty uncertain global economic outlook. We always hear that. I guess the key thing here is the geopolitical tensions. Yes, there's a war in Ukraine and Russia, or between Ukraine and Russia. The main change since the last quarterly catch-up was the change in the political situation in the US. There's been gazillion content written about Donald Trump already. The takeaway, I guess, excuse me, from what's going on globally on an economic front is tariffs. He's a big tariff president, and we're looking at here's a brief summary of some of the changes or tariffs that have been proposed or will be implemented so far. And really nobody's spared, right? The EU's getting slapped. Canada and Mexico, it's two major trading partners. China, of course. So yeah, and the question is, what impact does it have? We don't know, right? At the moment, the market seems to be shrugging off main concerns, but these things can take a while to play through the system. what I'm reading from companies in the US is that it's just creating a lot of extra red tape and confusion. So an example the other day that Converse, who makes the sneakers, great sneakers by the way, our kids wear them and I wear them as well. They managed to save a 7% or got a 7% cheaper tariff by classing their sneakers as slippers. Don't ask me how they got away with that, but that's just an example of the extra burden on business, let alone the financial. Growth projections globally, again, stressing that this doesn't necessarily link in the short term to what share markets do or asset markets, but reasonable number, right? 3.3% for this year and next year for global growth. Interestingly, US is powering ahead. Other regions are being revised down. US revised up, regions revised down. And I guess the takeaway is from that momentum was already there before Trump got in, and now it's only going to continue certainly in the short term because he's very pro-business. So that's a quick economic takeaway. Let's have a look at how it impacts your portfolio. And we have the hopefully familiar table for you of longer term returns. Top table is individual asset classes. Bottom table is putting those in a basket or a bucket, which is what we do for you. For the viewers that aren't clients, it's what you probably have in your super or your investments, whatever, if you're properly applying the principle of diversification, not having all your eggs in one basket. So the top, again, if we look at the 10-year, the green table here, still very strong returns from global shares, Aussie shares as well. So the right-hand side from the basically domestic property onwards is the growth investing area for 90% of the population. This is where you can earn the best returns, but not without risk. Having said that, it's been a benign couple of years. I'll show you some other numbers in a minute, which will illustrate that point. The orange at the bottom is the 1-year return. So again, these are volatile, right? At the moment, the number's great because it's positive and it's quite large. So for example, to the end of January, Aussie shares, including dividends, earned 15%. But global shares almost double that, right? Nearly 30%, including dividends. Emerging markets are doing very well as well, which is good to see because they've been lagging for a while. As you can see, the 5-year numbers, big gap. So hopefully that trend will continue, particularly for clients where we've introduced the emerging markets theme. The bottom table is the blend, right? So the bottom table is more a better indicator of what's happened and what you might expect in the future. History doesn't repeat, but it may rhyme. Hopefully, let me zoom this and hopefully, let's just see. Hopefully people can see it. I'm just going to check my chat, see if there's any messages here. Make sure we are hunky-dory. Okay, good. So let's pick the 10-year where my cursor is. And so what this shows you is the last 30 years measuring the 10-year return at the end of every month the last 30 years. So effectively it's 360 data points, right? A lot of information, the point being that it's a pretty robust analysis, a good starting point to think about where a portfolio has been in terms of returns, what's the best and worst years that you've had, and why that's important is mentally preparing for what the future might hold with the best that we can, which is looking at history. We obviously don't have a time machine yet to go into the future. And so if you look at the 10-year returns from a 70-30 portfolio, so you go down 1, 2, 3 across 1, 2, 3, 4. The compound annual return as a guide was around about 7.4. Again, this is very broad guide. Your portfolios can be different for many reasons, but just as a starting point. And a 50-50 portfolio. So just to explain the difference, 70-30 means 70%, 70% in growth assets of some kind. So those columns we looked at in the table up the top, up here, property shares, etc. And 30% in defensive or income assets, so cash, bonds, and global bonds. So that's what the 70-30 mix is. So the last 10 years as a guide are Standard portfolios earn about 7.4%. These are pre-fees. So if you're paying advice fees or accounting fees in your super fund, whatever, that's a separate thing. A 50-50 portfolio. So again, half your money in this side, cash and bonds, half your money in growth, shares, property, etc. 5.5%. So pretty respectable numbers, beating inflation in most cases. As you can see, inflation isn't here actually, but the cash rate is. So well over the cash rate. Even the conservative portfolio 50-50 has done double the cash rate, which is what you want, because the bottom table shows you what downsides you have to endure, at least on paper, to earn those kind of returns. Let's pick the 70-30. Again, the worst year in the last 360 rolling 12-month periods, a year, has been a paper devaluation of 23%, right? Nearly a quarter. I'm pretty sure that was in the global financial crisis. So the trick is to be aware that that can happen. Most of you who've been with us long enough have lived through that, and credit to you for staying the course to earn these returns up here. You've got to periodically endure negative returns. Certainly there's no magic formula to avoid that at the moment. So, and a 50-50 vastly lower downside historically, but also, you're giving up some of the growth longer term. There's no right or wrong. I picked these two portfolios because they tend to be some of the most common that we see. So let's have a look at some other data, similar fashion. This is the Vanguard Growth Index Fund. So again, if we go back here, basically it's a proxy or a representation of a 70-30 portfolio. So they aim, these are index returns, by the way. So the what they call the benchmark, or the measurement, the yardstick, or the numbers which you want to see your fund sort of tracking around over time, other things being equal. And so if you want to actually, as a very basic starting point, invest in the nearest thing to that benchmark, Vanguard or Dimensional or BlackRock do that. They offer that product. So for many of you, we use a version of this or this approach. And that's why it's such a relevant thing to look at when we have these quarterly catch-ups and possibly similar conversations in your individual personalized reviews as well. So this is the Vanguard Growth Index Fund, right? So that's a 70-30, around about a 70-30 mix. And what I've done here is presented the information a bit differently to last chat. Third column here is the total return. And this is calendar year. So this shows you, so again, the numbers in the previous slide were to the end of January. In other words, the most recent sort of 12-month period looking back. This is calendar year. So doesn't matter so much about the measurement date. It's more the principle of showing you what to expect or what's happened in recent years with returns. And you can see here that the last 2 years, the portfolio, a 70-30 portfolio has earned around 13%, right? With dividends and growth. Previous year was a terrible year, it was down 10%. Previous 3 years, again, positive return. I don't know, what's that average of maybe, low double digits there. And then 2018 was another down year as well. So you can see that it goes in cycles, right? You have a couple of good years and then a down year. So the thing to always take away from this is that, particularly when things are going well, sooner or later there will be another pullback. It's that 2 steps forward, 1 step back process of growth investing and compounding. And it's really important to understand that, particularly if you're putting more money to work, or you're new to investing, or you're just a naturally jumpy person, which is perfectly normal when it comes to your money. So that's a really interesting thing to think, is like, yep, okay, 2 good years. Not saying there might be a good or a bad year this year, but you can see that every 3 or 4 years it happens. Interestingly here, where's the GFC? There it is, 2008. So there's your down 23%, right, for a 70-30 portfolio. Very similar to the numbers we looked at in the previous table, which is what you would expect. Let's have a look at the movement in the value. So this, again, hopefully looks familiar. Just a picture tells 1,000 words. And And if you look here again at the 2022 calendar, here's end of December 21. Here's the end of December 22. And it is lower, right? There. So that correlates that value. This is the value of $10,000 invested back 5 years ago. That correlates with the table we looked at, right? You can see, yeah, the value dropped in 2022, hence that calendar year negative return, at least on paper. But since then, the last 2 years, you can see the trend, right? The line keeps going up. Even the most recent data point, still very strong growth. So as always, I say, what do we have control over? Your situation, your need to possibly put more money in, like if you've downsized or you've got some savings or inheritance, when and how do we do that? Or your requirements to draw money out. If you've got lump sum or need to top up something or give kids money or fix up the house or go on a big trip. And so, at this point with prices at these levels, quite often we're, doing some rebalancing, taking profits or harvesting some of the growth from some of those funds in your portfolio that have done well. Or if you're a DIY investor, hopefully you're doing that and comparing where you are now with what your target is, whether you're a 70-30 or a 50-50. So it gets back to focusing on what you or we as your advisor, us as your team, have control over, because in 12 months' time, I can't tell you where this chart will be. I can tell you in 10 years it's going to be higher based on all that information that we looked at. So that's the market update for you. Let's go into the masterclass and have a little talk about active versus passive. Where is it? If I can find it. Where did it go? Bear with me, folks. Where's work? Here it is. Did I save it? Active versus passive. Okay. Let me just open the file. It looks like it's not bookmarked. In the meantime, I'll bring this table back for you to have a look at while you're waiting. Scroll that down a bit so you can see it. Okay, just bear with me, folks. So we're going to virtual coffee. I'm going to dig up my article. Here we go. Share. See if this works. Okay. Mini masterclass. Let me check the chat. Is there any commentary? No, we're good. Okay, and I also did, this is a little bit of an expansion on, I don't know if any of you watched my one minute money message, which is the idea of being a very brief educational piece or topical comments on something that's happening. So I talked about in a recent one minute money message, the difference between passive or indexing and active investing. And basically, imagine investing is like picking stocks. I mean, that's one option, right, for investing is picking stocks. So passive investing or indexing is buying everything, right? A little bit of everything. And the idea is you're trying to match or beat the market. So the market being those numbers we looked at in the blue table, that's the benchmark or the target, right? That's what is being provided to you by the returns in which the assets in which you can invest. So an example of a passive or indexing approach is something like the Vanguard Australian Shares Index ETF. They also have a managed fund. ETF is an exchange traded fund. So you can buy it like a managed fund, but like you do shares, buy and sell on the stock market. So for some people, that's easier. And that tracks the S&P ASX 300. So by way of example, these returns we look at here, that domestic shares return is the ASX 300. So the passive approach would aim to give you that return. Not trying to pick out of those 300 stocks, maybe the 50 that do best. The 50 that do best is what is or an example would be is what's known as active investing, where you have a team or an individual, generally a team. Sometimes there's a couple of stars in that team, and they try to pick the stocks that are going to do better than the 300 stocks, right? So a good example is the Fidelity Australian Equities Fund. Again, these aren't recommendations, just an example. Talk to me offline if you've got any questions specifically. But they generally, Paul Taylor, the guy's name is the last I checked was Paul Taylor. He's got a pretty good long-term track record, so managing to beat the returns from this. Last I looked, and they have 30 to 50. He generally had 30 to 50 of the 300 largest Aussie stocks. So constantly scouring through that 300, trying to find which one's going to do better. I guess to a degree it's a bit of a crystal ball, but something that for this guy seems to have worked. So what's the difference in cost? So passive or indexing is generally cheaper and often outperforms over the longer term. And active investing is more expensive, but potentially you're going to beat the market, right? And I say potentially because it's really hard to figure that out. So by way of actual costs, this is sourced from Morningstar, who's a major research provider. They look at thousands of funds and super and managers every year. So pretty reliable source. They say for an Australian, again as an example, a typical Australian equities fund, so something like a Fidelity, I think theirs is a little cheaper than one from memory, might be 0.8 or something, just over 1% on average, right? So you have to beat the market. If the market does 10%, an active manager actually has to earn 11 just to match the market, because they've also got to earn their fee, take that out of your pocket, and then beat the market. So it's already an additional hurdle. And there's no right or wrong other than to say, let's look at the evidence and the data, which I'll get to in a sec. But the typical indexing or passive approach is roughly half the price, right? Again, big Aussie equities. So I think the Vanguard ETF we talked about up here is something like 0.2 or 0.3. It's very competitive, right? So a third of the cost of an average Australian active fund. Hopefully that's making sense. Let's look at the evidence. So this is research provided by our investment team in our head office with our dealer group, FYG planners. And we've taken a sample here of 3 different styles of investing funds, active funds, right? So a Fidelity style where they're trying to pick the best, whatever, 20, 30, 40, 100 stocks that are going to do better than the overall market, and charge a fee to do that. And hopefully after they take their fee out, they're still beating the market. Over 10 years, again, let's just pick on Aussie managers, active managers, stock pickers, Australian equity. Over 10 years, 80% plus of those funds didn't do better than the market. So saying that another way, only 1 in 5 or less than 1 in 5 managed to beat the market. And a big part of it is because their fees are so high. It costs more, right, to do that work, to have a big team of analysts to go meet, management and go out and visit warehouses and mining sites and ports or whatever that might be. The numbers are even worse for global, as you can see. Roughly 9 out of 10 global and US equity funds didn't beat the market. So sure, you've got, you have exceptions, and Fidelity might be a good example. The challenge we have as your advisors is finding a process consistently that can always have those 1 or 2 managers in the portfolio. It's very hard, as you can see from the data. And it's interesting that the Aussie gap is not quite as bad. And the only thing I can think from that is maybe it's a bit less competitive in Australia. There's less fund managers here, so there's a bit more opportunity perhaps. But the US market is extremely deep and liquid, biggest financial market in the world. So there's a huge amount of competition, right? Lots of very, very, very smart people all trying to do the same thing. So where's your edge? And as you can see from the data, it's very hard to find that edge. 1 in 10 in the last 10 years have had an edge that's managed to beat the market after they take their fees out. So that's a mini masterclass in indexing or passive versus active. For the most part, we favour as you would know, if your clients of ours, we favour sitting on somewhere in between the active and the passive, using funds like dimensional or some form of systematic investing approach that is repeatable and it can provide a small edge over time. If you're a viewer and want to know more about that, just book a call on free call on our website. Last but not least, let's have a look at my favorite hacks for the day. Any messages? No, we're all good. Hopefully people are still with me. I forgot to have my coffee, but that's what microwaves are for. Rock and roll, rock and roll. So, what's next? Tech. Okay, where is it? This is something that looks pretty cool, and I'm a big user of Amazon. Where did it go? Okay, I'll just pull it up. Sorry, I thought I bookmarked it. So this is cool name, Camel Camel. This is an Amazon price tracker. Don't know if anybody's seen this, but I think it's pretty cool. I spend a lot of money on Amazon, much to Ali, my wife's dismay sometimes when all these packages rock up and they're not for her. But I try to be disciplined. So this is an app or a plug-in you can install on your computer that will alert you if you're looking at something on Amazon, the price drops, you get the heads up. Pretty self-explanatory. You know, it's got different categories, different filters and so forth. But effectively, let's say you're looking to buy some Bluetooth headphones, for example, like these things. Well, these are wired, but you get the idea. And you might love Yamaha, right? Or you might be monitoring something. There's an example there. You've got your Yamaha headphones, big discount, right? So yeah, simple thing. You can set up alerts. You can set up a price history. So for big ticket items, this may be really useful. So Camel Camel, love the feedback if anybody uses it or does use it, ends up using it, has a great experience, let me know. Always welcome feedback. The next thing I wanted to mention was cash rewards. I had talked about this before. This is a no-brainer. And again, I was saying to Ali, my wife, whenever we go shopping or particularly online stuff, always try and go through cash rewards to see if this, if they're on the portal. So what this is a cashback scheme. All you need to do is set up an account with these guys. It's free. And then you click on the shop you want to go to once you've logged into your portal, and you purchase as normal. So an example is, let's say you want to buy a new coffee machine with Breville. All you need to do is click shop now through this website, and you'll get 7% cash back on your coffee machine. It's amazing. So Amazon is on here. Speaking of recent comments, I use this. I log into Amazon and purchase on Amazon through here. But there's quite a lot of exclusions for Amazon, right? So you get, I think, the most generous cash back for them is if you buy Amazon products. So an example is we've been buying some smart speakers, the Amazon Spot and the Amazon Echo, and so we get cash back on that. But I think you get the gist. There's all the categories along the top here, so really worth doing. There's my balance, right? So what I do then is periodically sweep that across to your nominated bank account. There's no catch, right? Once you set it up, that's it. And the main thing is just getting into the habit of going here first before you buy something online and seeing if the store that you're using is listed. They also sell discounted gift vouchers sometimes as well. But look, here's eBay, right? You can go to eBay, get 4% off, which I think the eBay is quite generous because their margins are so slim. Uniqlo, Adidas, so we sometimes buy our gym gear and sports gear for the girls through the website, Puma, you name it, all kinds of stuff. So I think I made the point. Get on cash rewards, and yeah, periodically, if you do have an account and the balance is building up, periodically I'd sweep that, right? So set a reminder every 3 months, or when it hits, keep an eye on it when it hits a couple $100, just in case. If these guys disappear, your money goes with them. So they're not like a bank where your money's guaranteed. And my job, again, is to think about the what ifs as your advisor. So cash rewards, Camel Camel. Last but not least is a great article I found on Money Mag in December. Great magazine. I've talked about it lots in the past. Any resources you can use to get an edge. I say go for it, right? I mean, that's what I'm here for, to help you. But I'm here to say money has some great tips. This one's health insurance, and basically the takeaway is here. And according to this article, not a lot of people know about it. But effectively, if you've got adult kids, they move out of home, they can stay on your plan until they're age 31. And it's according to this, it's a lot cheaper than those kids moving on to an individual plan. So again, if anybody's done this or heard about it, welcome any feedback. But effectively, the federal government made this change in 2021. And the estimate here is an average family could save $1,700 a year, right? Or your adult child is not having to spend that money on their own policy. We spend about $8,000 a year as a family of four. Not applicable for our girls yet because they're still school age, but this is really good to know. If they say they move out for university and they're singled and for a while and don't have kids, we can keep them on our policy and save some money. So the double tick here, as it says, which I thought was great, they don't have to be living with you, according to this. And again, check the detail if this is of interest. The only requirement is that they're not in a de facto relationship and don't have kids. Other than that, under 31, go for it. So yeah, if you've got kids or your kids with their kids that are in this situation, just something I wanted to point out. So hopefully that's been of value. There's our wrap up again. Everything covered. Welcome any feedback. We'll have a playback available if you want to forward it to any friends or family, or just direct them to our website, providencegroup.com.au, if they want to book a free call. And thanks for watching, everybody. Hope you have a great weekend. The first thing I'm going to do is go and heat this baby up and finish my coffee. So talk to you in 1 quarter. Thanks for watching.